Hello everyone, good morning, good afternoon, good evening. How are you feeling? I hope you are feeling that economics is really complicated. I hope you are feeling the depth of the subject. We are really into the heart of monetary policy. We have completed fiscal policy, we have completed taxation, and now we are going towards completion of monetary policy. These three form the pillars of our core economics or conceptual economics. See, rest all chapters like poverty, employment, these are all very fairly easy to understand, right? Because that can be practically felt or practically seen, poverty or employment, unemployment scenario, etc. But these chapters are very tough because of their conceptual content. Rest, other than that, they are very easy. Okay? So we'll just we'll start through this, right? We'll start through this and we'll continue what we have done in monetary policy so far. So please quickly revise with me, what have we done in the last lecture about monetary policy? What do we know about monetary policy in the last lecture? We know that Monetary Policy Authority of India is the Reserve Bank of India. It is also the Central Bank of India. We saw a little bit of history. We saw about Hilton-Young Commission in 1924. They gave a recommendation that to separate the central banking and commercial banking functions of Imperial Bank of India, right? So after Imperial Bank of India, say central banking functions were removed, then what did we do? After that, we established RBI according to RBI Act 1934. Yes or no? We used RBI Act, or we initiated, or we legislated RBI Act 1934, and RBI came into being with effect from 1st April 1935. Right? Since 1935, RBI has been the Central Bank of India. But was RBI a government bank in the initial days or since the initial days? No, absolutely not. RBI was not a government bank. RBI was a privately owned bank up to 1949. In 1947, we got independence, and in 1949, we nationalized RBI. When I say we nationalized, I mean that government shareholding in the RBI was increased to more than 51%, right? We nationalized RBI, and then RBI came fully under the control of the government, and since 1949 it has been a government bank. It is RBI, it is the Central Banking Authority of India. What happened to Imperial Bank? Imperial Bank of India was then a commercial bank. It is still a commercial bank now, but after 1955 the ownership changed from private to public. We also nationalized Imperial Bank of India in 1955, and we renamed it as State Bank of India. Okay, all clear? Very good. Yes. Then we saw that monetary policy has one principal tool, which is to control interest rates. When does monetary policy, or when does RBI increase interest rate, and when does RBI reduce interest rate? What do you think? So when we are in an expansionary phase, when economy is growing, when economy is on a height, or when economy is going upwards, then what would we do with the interest rate? Just think and tell me, what would we do with the interest rate? Would we increase interest rate, or would we reduce interest rate? What do you think? What should we do? When economy is growing, when economy is going up, to prevent it from going up further, because upper there is only heating, there is only inflation, there is only air, there is no real growth above a certain point. So monetary policy should start increasing interest rates, should start making funds costlier, right? We also saw that commercial banks borrow money from central banks. So this is commercial bank, this is central bank, which is RBI. So this is RBI, this is HDFC, and these are people, right? So people borrow funds, people keep funds with HDFC as deposits. This is deposits. HDFC keeps its money with RBI as deposits. RBI also lends loan, and this money in turn is given by HDFC to people as loans, right? So if RBI, or if Monetary Policy Authority wants to make the money a bit costlier, or wants to make difficult access to money difficult, then what will RBI do? RBI will raise the interest rates. RBI will increase the interest rates. When RBI increases the interest rates, borrowing from RBI becomes difficult for HDFC, and hence if borrowing from RBI becomes difficult, lending also becomes at a higher rate, or lending also happens at a higher rate. See, I told you commercial banks are just middlemen, they are just agents. They earn their profit in these transactions, no doubt. So if they are taking loan from RBI at, let's say, 7%, they will give you at 8%, and the difference in the interest would be the profit of the bank. Simple, it is very simple. These are agents, right? We also saw, we saw two kinds of monetary policies, or two kinds of policies which which we follow in fiscal policy, we saw that we have an expansionary fiscal policy and contractionary fiscal policy. What does government do when it talks about fiscal policy, or what does government do when we when we want to reduce, sorry, when we want to follow an expansionary fiscal policy? If you want to follow an expansionary fiscal policy, then what will government do is government will reduce taxes. See, government has 2-3 tools in its hand: tax rates, disinvestment, right? If government wants to fill its fiscal deficit, if government does not want to borrow money from the market, then it will increase its disinvestment target, or it will increase the amount which it wants from disinvestment. So it will sell more number of shares. Okay. So if government wants to follow contractionary fiscal policy, contractionary, you want to contract the policy, so you increase the tax rates. When you increase the tax rates, less and less purchasing power is left with the people. Less and less purchasing power means less and less demand for the goods. Less and less demand means demand reduces, supply is still constant, assuming supply is constant. When demand reduces, your price would also come down, and then a new lower equilibrium would be achieved where demand and supply meet. Right? This is how your economy will then contract, and we follow a contractionary fiscal policy. Also, when you increase taxes, government's receipts increase, government's revenue receipts increase, total receipts increase, and its fiscal deficit reduces. Right? Always remember, when we talk about fiscal deficit and all of these, we talk in percentage terms. We talk about them as percentage of GDP. So fiscal deficit is 2.7% of GDP of that year. Okay? Which GDP of that year, real or nominal? Nominal GDP, sir. That we'll cover in the inflation chapter. How does inflation reduce the fiscal deficit? Okay? We'll cover that. We'll cover later. That is a little bit more advanced. So let us focus here now. We talked about interest rates in monetary policy. In interest rates, now tell me, if RBI wants to follow a contractionary monetary policy, what will RBI do with the interest rates? It will raise the interest rates. It will increase the interest rates. When it raises the interest rates, this flow becomes costlier. Indeed, this flow will become costlier, and then there will be fewer buyers, lesser number of buyers of loan, or lesser number of takers for that loan, thereby reducing the money supply in the economy, thereby following a contractionary policy. Okay? And ulta, if you want to follow an expansionary monetary policy, then RBI will tell you, take money easily. I am reducing my interest rate. It is easy for HDFC to take money from RBI and to lend it also. Okay, if HDFC is getting it at a lower cost, there are high chances that it will pass on that lower cost to the customers. Very fine, very easy, very clear to understand, right? We spoke, then we went one layer in depth. We spoke about what interest rates are we talking about here. So we saw a few interest rates. So first rate is called as repo rate. Yes or no? First rate is called as repo rate. What do we mean by repo? Repo means repurchase obligations, right? Repurchase obligation. So when HDFC borrows money from RBI, when HDFC goes to RBI, sir, I need money, I want to lend it out. Always keep in mind that HDFC also has deposits, and it also gives those deposits as loans. That is the main business, but it also takes money from RBI. Right? So when HDFC takes money from RBI, RBI asks keep some collateral. It is very essential to keep collateral. Right? So when RBI keeps collateral with HDFC, then HDFC keeps collateral with RBI, HDFC keeps collateral with RBI, RBI gives money to HDFC, and HDFC promises to repurchase that security, repurchase that collateral after a while, be it 1 day, 2 days, 15 days, whatever is the agreed upon term. Always remember, these are monetary policy factors, so that is why what happens is that these are all short-term funds in nature, right? Then we saw about something called as reverse repo rate. What is reverse repo rate? What is repo rate ka definition per se? Repo rate's definition is the rate at which commercial banks borrow money from RBI, or the rate at which RBI lends money to commercial banks. Ulta. Either you can say in terms of borrowing, either you can say in terms of lending. What is reverse repo rate? The rate at which RBI borrows money from commercial bank, or the rate at which commercial banks lend money to RBI. That is called as reverse repo rate. So now if RBI wants to make it difficult for people to access money, it will entice commercial banks to keep money with RBI and not lend it out to people. So what it will do with the reverse repo rate? It will raise the reverse repo rate. So when reverse repo rate is raised, HDFC thinks ki either I can give it out as loan at 6%, but that is risky because he might not repay the loan, that person might default, or I can keep it at 4.5%, but this is safe, it is RBI. So then more and more funds are diverted towards central bank, and less funds go to the public, and hence a contractionary monetary policy is followed. Okay? Reverse is true for, like, when reverse repo rate is reduced, RBI tells HDFC, you lend it out, don't come to me, you lend it out, enjoy. Right? So if both are reduced, repo rate is also reduced, which means borrowing from RBI becomes easier. Reverse repo rate is also reduced, which means keeping money with RBI is now not attractive, which means double flow will happen to the monetary to the money supply in the economy, right? Always remember, this is a limited pool of resources. This is a very limited pool of resources. Okay? So when a few big players or even the government with high fiscal deficit, high borrowing requirements, when a few big players come in this pool, what happens to the other players? What happens to the other players? They get sidelined, they get crowded out, right? So when this pool, let's say itna pool is borrowed already by big players, so this much only is remaining for small players like us, small individual borrowers or small firms. So what will banks do? Banks will raise the interest rate because supply is limited, demand is high for the money, and interest is the cost of money, right? So the cost or the price of money will be raised, interest rate will be raised, and we will find it difficult to get the money. Okay? Always remember that crowding out is bad because government expenditure might not lead to C&I of others, consumption plus investment of others. If private people buy or private people take a lot of loans from the pool, then there are chances that they will either consume or they will either invest it, right? So ultimately, what is getting increased, or it is benefiting which entity or what identity? Aggregate demand, which is your GDP, C plus I plus D plus X minus M, right? So keep that equation in mind always. The basics are always relevant for whenever we go deep into policies, monetary policy, fiscal policy, etc. Okay. Then we saw repo rate, we saw reverse repo rate. Reverse repo rate. Right? These are the two rates that we saw. Then we saw that we saw some windows also. We saw some windows, some special ticket counters or counters we saw. So first was liquidity adjustment facility, which was introduced in 2000. Liquidity adjustment facility is for intraday or overnight liquidity mismatches. You know, one day liquidity mismatches, emergency hotline. So you call, immediately funds are transferred to your account for only one day. So intraday it happens, or one night it happens. Overnight liquidity mismatches, liquidity adjustment facility. That is why it is called as liquidity adjustment facility, right? Then after liquidity adjustment facility, what did we talk about? So what is LAF? LAF is for short term need of funds. See, the funds amount is huge. It is in thousands of crores because they are banks, right? But still, this is only up to a certain point of time. What is the rate at which money is lent under LAF window? The rate is repo rate at which money is lent under LAF window. Then some bank says that I need more money, more than my requirement, more than my allotted slot under LAF. Then LAF people say, please call other helpline, which is called as marginal standing facility. Okay, which is called as marginal standing facility. This was introduced in 2011, and marginal standing facility will have more funds. They will ask for more collateral, and they will give loan to the bank, or RBI's marginal standing facility window will give more loans or more funds to banks, but at a penal rate. So it is a penal rate. Repo rate plus something they will give at a penal rate. This was marginal standing facility. Okay, very good. Then we also saw that expansionary policy is called as dear money policy or cheap money policy. Expansionary policy is called as cheap money policy, and contractionary policy is known as dear money policy, right? Then we saw how earlier there was also long term lending at bank rate, which was also a penal rate, but then that was discontinued, right? Then again long term lending has been started, and we call it as long term repo operations or targeted long term repo operations, right? These are repo operations only. See, repo operations by the word itself means that I am keeping collateral with you and I promise to buy it back from you. Buy it back means what? I will repay your loan and you have to give me back my collateral. That is repo operations. Okay, right? What else did we see? LAF हो गया, MSF हो गया, bank rate हो गया, LTRO, TLTRO हो गया. Then we came to something very important on how loans are priced or how loans are given to the people, right? We saw four regimes. What was the first regime called as? The first regime was very discretionary. The first regime was very discretionary. Ki whatever loan or whatever pehchan or whatever setting you have, depending on that you will get a rate of interest. So big people or powerful people, powerful borrowers with connections, they used to get loan at a low rate of interest, and the remaining pool of money for normal people, for small firms, for households, for individuals, that used to be priced at a higher rate because of crowding out. right? So this was a very what we say, you can say very inefficient or very corruption prone system that we had. Okay. Second was known as the base rate regime, right? We are not going in depth now because this is just revision. What was the whole concept of base rate regime? That below this rate you cannot lend. RBI told banks below this rate. Don't confuse this with bank rate, which we saw in the last screen. Bank rate was the rate for long term lending, which is now discontinued, but RBI still publishes bank rate, which is nothing but same as MSF rate, which is a penal rate, right? So this is a base rate. This entirely different thing we are talking about. Base rate is the rate at which RBI said ki you cannot give loan to your customer below this rate. Simple, base rate. But what did they start doing? They started inflating their profits. They started inflating their cost, right? So then we came on to the third regime, which is known as MCLR, marginal cost of funds based lending rate. You should know these full forms by heart. It is known as marginal cost of funds based lending rate. What is the difference between base rate and marginal MCLR? Try to think and try to tell me what is the difference between MCLR and the difference between difference between MCLR and base rate. What do you think is the difference? Try to think and tell me. I'll give you 2 minutes, 120 seconds to think and tell me the difference. And I want to know the difference in 2 lines. This is the trick which you have to learn from day 1 itself, to explain something or to in your own words, but in 2 lines. To use fewer words, to use concise sentences or concise words to explain maximum meaning. When you are able to do that, by the time of your exams, you will be a very good answer writer and a very good interviewee. Because even in interview they don't give you a lot of time to explain. So if in interview they ask you what is the difference between base rate and MCLR, you are expected to hit the bullseye in the first sentence itself. And then if they ask you to elaborate or they ask you to tell something else, then you can say a lot of things about it. But you have to answer in 1 or 2 lines only. What is it exactly? So, often what happens in interview is that there are a lot of counter questions to your answer. There are a lot of counter questions. So if you answer something, they will ask something else out of that answer only, right? But if you answer in a pinpointed basis, if you hit the bullseye, there are lesser counter questions. That is what I have seen by reading so many transcripts. That is what I have experienced also. And my friends have also experienced the same thing. So if you beat around the bush, they will ask you 10 more questions. But if you just give the bullseye, they will move on to the next question immediately, right? So try to think and tell what is base rate and what is MCLR and what is the difference between them. What changed from when we moved from base rate to MCLR regime? What changed? What do you think changed? See, in one line, if you want to say, I will tell you, base rate, the cost of funds was based on average rate or average cost was taken. And in MCLR, what is taken? Marginal cost is taken. Remember we did yesterday? Average cost means you are taking the average of all the past borrowings up to certain point, let's say 1 week, 2 week, you are taking the cost. And then tomorrow if RBI reduces the repo rate, then that new repo rate would have very less weightage in your average. Because earlier you have taken 10 loans at a very high cost. You means you are commercial bank. You have borrowed money from RBI, 10 borrowings at a very high cost and the 11th borrowing is at a very low cost, right? Because of the new repo rate, but average would be still high. Okay? So in MCLR, RBI said that you have to take the marginal cost. You have to take the cost of 11th loan only. You don't have to take the cost of past 10 borrowing. So that is marginal cost of funds based lending rate. But this was also do you remember this base rate and MCLR? We have done all this in the last lecture. Then we saw that this was also what was being difficult in these cases. Dash was difficult, and that is why we brought the fourth regime. Why are we going from regime to regime? Why are we changing regimes to achieve the end? To achieve what goal? Which goal is to be achieved to at the end of this? What is the goal that we are trying to achieve? Always remember, we are trying to achieve the goal of monetary policy transmission. Remember, monetary policy transmission. So rate cuts have to be passed to the consumer and rate increases also we have to be passed to the consumer. Is there a similar thing in GST? There is a similar thing in GST called as GST rate transmission or GST rate change transmission, right? Similarly, here also monetary policy transmission, MPT, monetary policy transmission is very important term to be used, and RBI constantly strives to achieve highest level of monetary policy transmission. So it is nothing but decreasing the distance between RBI and the consumers. Okay. Then we move on to the fourth regime. The fourth regime, we'll speak about it. Fourth regime was called as external benchmarking, or linking to external benchmarks, you can say. So external benchmark, if I write external benchmark, okay. Now we spoke that external benchmark means link the interest rate or link the loan rate directly to an external benchmark and uske upar take little bit of profit which is to be fixed in, as per MCLR regime, right? So in external benchmark, we saw that it was mainly introduced for small loans. It was mainly introduced for MSME loans, for house loans, which were very interest rate sensitive, because big people don't mind 9.2 and 9.3 ka difference. But for us, it is very important for us to have the minimum rate of interest to be able to afford things which we have to buy. And for small firms, so it is very important because they create a lot of employment, and in every village, every small district, every small town, there are various small firms which employ 5 people, 6 people, 4, 5 people. And if they are not able to access funds, then so many people are unable to be employed, or so many people are unable to get jobs because there are so many small firms. When we speak about MSMEs, you will realize that micro, small and medium firms are the largest exporters, are the largest employment providers, and are the largest contributors to GDP. It is not the large firms, it is the small firms which are very important, and they are also the largest sufferers of these kind of things. Okay, so external benchmark mein we link it to 4 benchmarks. Do you remember the 4 benchmarks? First benchmark was repo rate, you can say. Second benchmark was 91-day T-bill rate, which is the rate mentioned on 91-day T-bill. What do you mean by 91-day T-bill and 182-day T-bill? Which means that treasury bill which is valid for 91 days, and that treasury bill will mature after 182 days, 91 and 182. Then benchmark set by FBIL. I told FBIL is Financial Benchmarks India Limited. Okay? It is a company. They specialize in giving these benchmarks. What do? They take average rates of lending and borrowing across the country, across the world also. They make all complicated calculations, and then they give a rate. A 20-year-old housing loan or a 20-year maturity housing loan should be costing around 7 to 7.5%. So if your loan is linked to this rate, then tomorrow if FBIL changes its benchmark, then your loan rate would also change. ठीक है, समझा? This is all that we had done yesterday. So now we'll speak a bit about FBIL, Financial Benchmarks India Limited. What is this company about? So this company, who do you think are the workers in this company? So this company has a lot. See, always remember that commercial banks, in this case HDFC, we have taken the example. Commercial banks are a lot more in competition in India. So they are competing with one another. Axis Bank competing with HDFC, competing with PNB competing with SBI. They are all in competition with one another. Okay? It is normal business that they are doing. So everyone is in competition. So tomorrow if SBI reduces the interest rate drastically, HDFC will complain ki how are you reducing so much? It is competition. Just like Amazon flash sales, they give a lot of products at a heavy discount, and then our normal offline traders, they always complain. Similarly, Uber gives a lot of discounts, Ola gives a lot of discount, and the offline cab drivers or auto rickshaw drivers, they also complain ki how are they giving such less rate. Similarly, here also, if some bank is able to give low rate of interest, then others will complain. So hence, FBIL is an industry body. FBIL has all representatives from different banks in India. They come together and they set the interest rate ki this should be the rate. Okay? So there is an industry body called as Indian Banks Association. See, the name suggests a name is straightforward. It is called as Indian Banks Association, IBA. It is an industry body. Always remember, it is an industry body, which means it is a representative body of all the banks taken together, right? So Indian Banks Association. So whenever there are bank strikes, bank protests against wage increases, if wages are not increased, especially public sector banks, they are almost led by Indian Bank Association. Okay? So you should know about Indian Bank Association. It is an industry body. Indian Bank Association. It has representatives of all the banks in India. Indian Bank Association. This regime was brought with effect from 1st April 2019 onwards. So this is not for all loans. It is at the discretion of which loans have to be linked to external benchmark. But the thing is that all small loans, housing loans, personal loans and micro MSME loans, they have to be linked compulsorily. Other loans, it is at the discretion of bank whether to link or not to link, right? So there is another IBI sends people to FBIL. There is another body which sends, another two bodies, they send people to FBIL, because see, these rates are not only used for loan purposes, these rates are also used in capital markets, they are also used in money markets, share markets, they are also used in international transactions by other bodies. So this is an overall financial benchmarks India Limited, not restricted to banks and not restricted to loans. That is only one part of it, right? So IBI also sends people, these are banks. Then secondly, there is another association, another industry body which is known as FEDAI, FEDAI. Okay? What is FEDAI? Foreign Exchange Dealers Association of India, FEDAI. So see, the name itself suggests that foreign exchange dealers hai. So unka association, they send representatives to FBIL and they sit together and they decide the benchmark interest rates. There is one more body. There is one more body which sends people to here, and these three together combine and make FBIL. So that body is called as FIMDA, FIMMDA. It's okay if you don't remember the names, but it is, or the full forms, but it is very imperative that you know that FBIL is comprised of IBA, FEDAI and FIMDA. Fixed Income Money Market Derivative Association of India. Fixed Income Money Market and Derivative Association. See, even I forgot the full form. Fixed Income Money Market Derivative Association of India. Sir, what complicated things you are talking about? We are not understanding anything. It is there. It is just name. My name also you might not understand. वैसे ही है ये. Fixed Income Money Markets and Derivative Association of India. FIMDA, Fixed Income Money Market Derivative Association of India, Foreign Exchange Dealers Association of India and Indian Banks Association. These three bodies send people and these make up FBIL, and then these calculate rates, various interest rates. They do complicated derivative calculations and statistical analysis, and then they give the rates which are to be directly linked by banks when they give small loans. Okay? Is it understood? See, you go to a bank tomorrow. Tomorrow you go to a bank. You tell, sir, I want home loan. Okay, very good. So what will bank do? You know, today if you go to a bank, traditionally bank used to give you the rate. Ki, sir, you will get. So if you want to take 20-year loans, you will get at the rate of 8%. If you want to take 30-year loans, you will get at the rate of 7.5%, etc., etc. Right? So different durations at different rates of loans and different amounts at different rates of loans. See, today what happens is that when you go to bank to ask for loan, bank gives you an option. Sir, do you want a fixed rate or a floating rate? Sir, ये क्या नया है? What is new? Do you want a fixed rate or a floating rate? Do you want a fixed rate or a floating rate? Sir, what is this now? So fixed rate is that once you took a loan, once you said ki 8%, I am getting a loan, I am a customer, I am going to HDFC bank, I want a home loan. I took a loan at 8% rate of interest for 20 years. So that loan or that interest rate will be fixed at 8% only. All the calculations for the next 20 years, the EMI interest calculations will be made at 8%. Okay? Banks also give me an option to have a floating rate of interest, which means that every 6 months or every 1 year, the rate will change. So today I took the loan at 8%. I started my EMI. After 1 year, let's say bank tells me ki sir, my repo rate has reduced. Would you like a reduced rate of interest? So you say yes. So then your loan gets converted into a loan of 7.8% or 7.5% for the next 19 years. Then after next 1 year again, let's say bank says ki sir, interest rate has increased to 8.5%. So then again for the next 18 years, the calculations are made at 8.5%. Are you getting this? Okay. So fixed rate of interest means that you took a loan at 10% or 8% and then that is it. You have to repay according to that only. Floating rate means rate changes, rate keeps on floating, and it depends on what? It depends on these things. FBIL benchmarks, 182, 91 repo rate benchmarks. Okay? They are known as floating rates. So every 6 months or every 1 year, depending on the bank to bank and depending on the option which you have chosen, the rates are recalculated. So now this is fixed, yes or no? Once you say 8% is fine, everything is fixed. This is risky. Why? Because rates might go up also, rates might go down also. You don't have an option now. Okay? So if you took a floating rate of interest and let's say rates go down, then are you in benefit or are you in loss? If you took a loan at fixed and then rates go down, are you in benefit or are you in loss? You took a floating rate at 8%, floating rate at 8%. Tomorrow rate becomes 7.8%. Are you in benefit or are you in loss? You are in benefit. Why you are in benefit? Because now your rate has reduced. But tomorrow if the same rate goes to 8.5%, you have no option but to pay interest at 8.5% because you have taken a floating rate. Okay? So this is riskless, but this also has a potential ki if tomorrow rate goes down, then I am paying higher here. Na? Okay? So let's say I took at 8% and you took at 8%, but your rate is floating and my rate is fixed. Okay? Tomorrow rate becomes 8.2%. Who is loser and who is winner here? Who is the loser and who is winner? The person who took fixed rate is the winner here. Why? Because he is paying 8% only. But today rate has increased to 8.2. You had taken floating, so now you are losing. But again, after 8.2%, the rate goes down to 7.3%. So now he will feel jealous. He has to pay 8%, but then he is going to pay only 7.3%. Okay? This is called fixed rate of interest. This is called floating rate of interest. Banks give you an option. Depending on bank to bank, product to product, policy changes amongst various banks and amongst various products. Okay? So there can be policies like if you are taking a 10-year loan, then there is only fixed rate of interest. But if you are taking a 20-year loan, then you will get an option of fixed or flexible, fixed or floating. Okay? So ऐसा different policies होता है. The concept is important. What is fixed rate of interest and what is floating rate of interest? Do you understand? Right? Very easy. Okay? So now fixed हो गया, floating हो गया. So when we speak about floating rate of interest, it is always fraught with risks. Ki the rate might go up. Okay? But the downside is that ki, you can get the other side is that you can get a benefit also if the rate goes down. Right? After 2018 or after 2018, RBI instructed all the banks to give an option to the existing loan holders. Give an option to the existing loan holders who had taken a fixed rate to give an option to convert them to floating rate if they want. So you can convert if you had an old loan, let's say you had taken a loan in 2004. At that time, floating rate regime was not there, only fixed rate was there. But after 2018, RBI gave an option for old loan holders also. If they want to shift to floating rate of interest, then you have to give them an option. Then when banks gave an option to floating rate of interest or to convert floating rate of interest, many people did opt also, some people did not opt also. So banks also charge a lot of fees for the conversion, processing fees and all, right, to get this converted to this. And then again there was a lot of criticism of the banks. They are charging a lot of processing fees. So they charge somewhere around 2000 rupees per 1 lakh of loan. So if you have taken a 10 lakh loan, then 20,000 rupees as processing fees. Vaisa. Okay? Anyways, this was fixed and floating rate of interest. Did you understand? Okay? We are here. There are different windows available now. Okay? Chalo. Now I'll give you a very interesting example. Every one of you faced demonetization. Every one of you was alive during demonetization. Every one of you was saw how demonetization happened, the pros and cons of it. We are not discussing demonetization here now. Okay? So in demonetization, what happened is that in demonetization happened in which year? 2016. Okay? 8 November 2016. Everyone knows this date now. Right? Or koi date you might not remember. You might not remember the birthday of your boyfriend or girlfriend, but 8 November is etched in everyone's memory. Okay, I remember I was in library, I was studying, and at night, somewhere around 10 o'clock, this announcement was made, 9:30, 10 o'clock. So my friend came, and in the library, I was alone, and my friend was there. He was studying in some other, he was studying outside the library in the corridor, and he came and he told me, ki, do you know your all notes are invalid now? I was shocked. I was like, what are you talking about? All notes are invalid. What is happening? I didn't believe him. And in my library, our library was in the basement, so we did not have internet there. Like internet didn't used to reach there. Network problem hota tha. So I could not verify it on the internet. He might have spoken to someone and he might have come. So I ignored him. Ki, Arey, aise kaise ho sakta? How is this possible? Then I took my bike and I started to go towards my room. Uh, at 11:30, I left the library. I used to stay. I was the first person to come to library and the last person to leave library. So I left library. I closed up the library and I handed over the keys to the guard and I took my bike and I was going towards my room. Okay, my room was around 10 minutes on bike away. Thoda dur tha. It was a bit far. So I saw that there are a lot of people on the petrol pump. Lot of cars, lot of bikes, and petrol pump was overcrowded at night 11:30. Then I realized that something is fishy and something has happened. And then I read online that after 12 o'clock in the midnight, the notes cease to have validity. So people were queuing up at petrol pumps so that they will use the old notes and they will get petrol filled in their car so that they don't have to change the notes. Right? Then I realized this is something big. And then of course I went to my room and I saw the news and everything. Then I realized what demonetization was and everything. Okay? So demonetization, mein, what do you think? People borrowed a lot of money or deposited a lot of money? What do you think? People gave their old notes to the banks or people took old notes from the bank? People gave their old notes to the bank. See, always remember when people are giving their old notes to the bank, they might not. Again, one important revision which you missed was the distinction between fiat money and legal tender. Remember, we yesterday discussed fiat money and legal tender. Now, you tell me what is the difference between fiat money and legal tender? What is fiat money? I'll come to demonetization back because it has a linkage with fiat money and legal tender. Hence, I'm asking you, what is the difference between fiat money and what is legal tender? Fiat money is money which is not backed by reserves. Simple, finished. Legal tender is money, or legal tender is the money which the receiver is legally bound to accept. He cannot refuse it, right? So can I say that the old notes ceased to be legal tender after 12 a.m. of 9 November? The old notes ceased to be legal tender. Yes, they ceased to be legal tender because after that you cannot force anyone to accept old notes, right? So old notes ceased to be legal tender. Did the old notes cease to be fiat money? Yes, because they were completely removed out of circulation. New notes were printed. Okay? Chalo. Anyways, the point I'm trying to make is that, see, a lot of them deposited money in their bank accounts, right? They said, we don't want cash, see, because new currency notes were not printed itna fast. New currency notes came 2-3 months down the line and then you got new currency notes. Yes or no? There was a lot of chaos in November, December. I remember my mother works in a bank. So she used to come home at 12:01. She used to go in the morning at 7-8 and come home at 12:01. Itna bank employees were worked and overloaded. Okay? So in these 2-3 months, what happened was people deposited a lot of their old notes in the banks. Banks were depositing. A window was given to deposit old notes. Yes or no? So if you give 500 rupees worth of or 1000 ka note, and then that money will be credited to your account. The only thing is new notes were not into circulation yet. So you had to wait a bit. Okay? If you have setting, then you could have got new notes. That is not a problem, right? So what do you think happened to the money supply in the economy? What do you think happened with HDFC? Did HDFC receive a lot of money or did HDFC pay a lot of money? What happened? HDFC received a lot of money in a very short span of time. In 1 month, everyone rushed to banks and everyone gave their old notes and said, please credit my account. I will take the new notes later on. Yes or no? RBI finds this risky. Yes or no? Because if HDFC, who has received a lot of money, gives away that money as loan, not in currency, it is only accounting entry. You just have to credit the account of the loan taker and debit your personal account or whatever. So if HDFC, who has got a lot of loans, or commercial banks who have got a lot of money, who have inflow of money, if they start giving out as loans, what will happen? What will happen? Unintended expansionary monetary policy. Do you agree with this? Unintended. RBI is sitting comfortably. Demonetization happened. People are giving a lot of money in the banks. A lot of money is flowing in the banking system. Bank is not going to sit on it. What will bank do on it? Bank will give away a lot of money to as loans. Yes or no? Because banks' operations were going on. Banks were not shut down. So RBI said this is unintended expansionary policy. It might lead to inflation. Yes or no? Because you will get a lot of money in your account. You will do online payment. Amazon, so you will order everything available on Amazon if you get a lot of money. Okay? So what RBI did was, RBI said कि we have to suck this money out of from banks also. बराबर है? We have to suck this money out from the bank's hand also. So what can RBI do? RBI can ask HDFC to keep the money with itself, yes or no? But the traditional tools, remember these tools or reverse repo rate and everything, these are for short term only, yes or no? RBI says कि we have to hold this money and the amount is huge. We cannot use these old tools. So RBI asked government, sir, what to do? Why? So government is asking what is the problem. RBI said कि sir, a lot of money has come to the banking system अचानक से, and if it flows back to the money supply or flows back to the people in form of loans, then our economy might lead to more than growth, might lead to inflationary states, it might lead to unnecessary purchasing power in the hands of people. So RBI said कि increase the reverse repo rate. Sorry, government said increase reverse repo rate. RBI said, sir, we can't do that. The volumes are so huge that we cannot offer a very high rate. Okay, we cannot offer a very high rate. We don't have that much of money to pay the interest on it. See, RBI pays interest on reverse repo, yes or no? RBI said, I don't have the capacity because the money is so huge, right? So government says कि ठीक है, let us do one thing, I will pick the money up. Government says, I will pick the money up. So now if government is borrowing money from people or from banks, basically if government is borrowing money from banks, who is the borrower? Government. Who is the lender? Banks. So instead of banks giving money to the people, banks wanted to give money. Now government wanted to induce banks to give money to government. RBI said, I cannot do it. Simple, because the volume is so huge, right? So now, what would you think? Who will issue a bond? Will government issue bond or bank will issue a bond? Government will issue a bond because government is the borrower. Okay? So new bonds were created for just for the purposes of this. But who is the agent of government? RBI. RBI acts as an agent of government. Who is the banker of government? RBI. RBI acts as a banker. So entire this logistics or entire finance aspect of this was managed by RBI. Okay? So that those funds or so a new window was created now. In RBI, a new window was created and there was government sitting there. Government said कि there was RBI का आदमी sitting there and government sitting there, and they said कि they called commercial banks कि borrow, keep your funds here. Commercial banks went to reverse repo window and RBI said कि I cannot do it. Go to new window which is created. This new window was created in 2018, 2 years after demonetization. This new window was created. ठीक है? This new window is called as, very important, this new window, we'll write it on a new page only. So post demonetization, a new window was created. Post demonetization, a new window was created in 2018 called as SDF. Sir, what is SDF? It is nothing but standing deposit facility. In 2018, new window was created. Sir, why 2 years? Because see, demonetization happened at the end of 2016. So 2016 तो खत्म हो गया. November में did it ना. December 1 month. तो just to understand what is happening, everyone took 1 month. Even banks took 1 month to understand. Then government approval and everything, and government also had a lot of explanation to do. Government was also working on GST. Remember, GST also came during same 2017. So that is why this took a backseat. And then finally in 2018, RBI said, sir, please, sir, lot of money is there in the economy. Do something, right? Then government gave approval to standing deposit facility. In this, excess money is sucked out from banks, and banks are given bonds. Yes or no? SDF bonds. And hence a large inflationary, possible inflationary spiral was prevented. Okay, this happened in post demonetization. Did you understand this SDF, standing deposit facility? It is to suck out excess liquidity from the banking system. It is to suck out excess liquidity from the hands of the banks, right? Who issues these bonds? Government. But who issues on behalf of government? RBI, because it is an agent. RBI gets commission and all. RBI also gets commission. Government says कि if you are acting as an agent of someone, you can also buy it for your own self also, no? Because you can. So government said कि आप भी इसमें थोड़ा हाथ धो लो. You can also buy some if you have excess liquidity. Government said to RBI, if you have excess liquidity, you can also purchase this excess liquidity. ठीक है? Very good. Now I'll give you a similar window. this concept is applicable in a new window, in a similar window. Remember I told you that Indian economy, we also saw the GDP chart in that Indian Express article. Indian economy grew a lot from 2001 to 2004. Do you remember? 8%, 7.88%, 9% also reaching. Why do you think? I had given you the reason. What happened in first 2000 years, 2000, 2005, 2000, 2007? What happened in those years? What are we experts for in the world? IT, software exports. So in 2000, dot-com boom happened. Lot of websites were created and we were giving software services, okay, because labor was cheaply available. We were educated in software and all, right? So you must have seen many people going to US in 2000s because that was the time when jobs also boomed everywhere around the world, right? Okay. So now in 2000, 2004, lot of growth is happening, lot of growth, very good growth. We are exporting higher services, yes or no? We are exporting software services. We are sitting in India. Call centers were opened in India. BPO, business process outsourcing, lot of call centers and BPO offices were opened in India at that point of time by multinational corporations. Okay, so almost everyone wanted to open a call center in India. Microsoft se leke, Amazon se leke, everyone wanted to open a call center in India. Why? Because labor was cheaply available. They could speak English, they could understand technical language, and they were proper literate and educated, right? So you must be very small during that time, but when I was in school, there was a lot of craze for working in call centers because call centers used to pay higher salaries. So for one who is 10th passed, at that time they used to get 30,000-40,000 rupees, and at that time it was a very big thing. They used to get 30,000 as starting salary, 10th pass or 12th pass. Just imagine. Aaj bhi nahi hai. Today also you don't get this salary, right? So there was a lot of craze during that time. Okay? Because what is required for working in a call center? Good English is required, and they teach you the technical stuff, and you don't have to know entire things about all products. And they allocate departments, so you work in the software department, someone will work in the hardware department, etc. Right? So now, right? So this is so what happened is after 2000, a lot of, do you think a lot of foreign exchange would have started coming in after 2000? Because we are providing services to clients around the world, so they will pay in dollars. Okay? So a lot of money, do you agree with this? A lot of dollars and exports of services were very high in that time. GDP growth was very high during that time, and a lot of dollars were flowing in the economy. Now how dollar flow works? If you, let's say, if you provide some service or you sell something, chalo, you have some tablet, you have Samsung ka tablet, and you found a buyer in UK, and he tells ki I am not able to find it anywhere in the world, you have it, you tell any price, I will give it. You have to ship it properly, box mein dal ke packing se, you have to ship it to UK. ठीक है? You ship it to UK, you pay in rupees, he will pay you in dollars. So when you get dollars, what will your bank account do? Your bank account will automatically convert into rupees and credit the rupees in your bank account. Yes or no? Now imagine crores of people earning similar dollars for providing services. Their dollars are flowing in, foreign exchange is flowing in, flowing in, flowing in. What do I mean by foreign exchange flowing in is Indians are earning in dollars, and we all know that dollars has a higher value compared to rupee. So when you are earning high in dollars, your bank account balance is increasing. Bank account is in rupees because bank will convert it. HDFC will convert dollars to rupees, and how HDFC converts it? It goes to RBI, it tells, sir, this guy has earned $100, please give me rupees. Bank goes to RBI, and RBI ke through dollar conversion happens. We'll see in the balance of payment chapter where we deal with import export, right? So now when you are working in a call center, you are getting your salary, the entire call center is earning in dollars, $10,000 per annum. Call center ka bank account is raising, yes or no? Is similar case happening? Money is flowing in the banking system at an alarming rate, right? Same thing happened, very similar thing happened in 2004, 2003, 2004. RBI said, sir, we don't have that much bandwidth to suck all this liquidity out. Already we are growing at a very high rate. समझ में आ रहा है? Already we are growing at a very high rate and more dollars are coming in, sir, it is very bad, sir. Today people are enjoying life, tomorrow they will more enjoy life, and the essentials would be so costly that everything would collapse. So government said, let me do something. Government again opened a new window in RBI. Okay? That window government opened in 2004. Okay? I took these two together because the nature is similar. You need to understand the nature is similar, and that window is called MSS. See this, see this. Intended to suck out the excess liquidity from foreign exchange inflows, market stabilization scheme. So what do we mean by here? Government will again issue MSS bonds. Who will purchase these bonds? Banks will purchase these bonds and money will go out from banking system to the government. Government is happy because it is getting to fulfill its fiscal deficit obligations. RBI is happy because excess money is not flowing to the economy. Banks are unhappy because they are forced to borrow these bonds and not to lend it out to customers. Okay, because these would be at a lower rate of interest. Always bear in mind, this is not very high rate of interest. These are not lucrative enough. But if government is forcing you to do it, then you have to do it. Okay, so these two are. So I always told you in the first lecture, that whenever you see a date or whenever you see a year, try to think about the context in which that would have happened. You might be right, you might be wrong, but at least that is thinking. So this happened because of .com boom or IT exports. This happened because of demonetization, right? So whenever you see Insolvency Bankruptcy Code 2016 or let's say Income Tax Act we saw 1961, something might have happened in 1955 to 60 that led to the creation of Income Tax Act. Okay? I told you wealth tax was abolished, right? You know, Wealth Tax Act ka year was 1957. So 1957 Wealth Tax, 1961 Income Tax within a span of 4-5 years. And for government 4-5 years is nothing. We saw GST has been in discussion since 2003 and it came into effect in 2017, 16-17, right? Okay? Did you understand this? So now what are we doing here? Are we sucking out excess liquidity? Yes or no? Okay? Now, very important aspect I am telling you, is this sucking out excess liquidity free for government or it comes at a cost? It comes at a cost. What is the cost? Known as interest cost, because it will have to pay interest on this. Okay? Very important concept I am going to teach you here. A generic concept. It is a, see, these are specific windows. This was made for sucking out dollars or sucking out foreign exchange liquidity. This was made for sucking out excess funds which had arrived from demonetization. So these are now deactivated. If tomorrow something happens, these again windows will be activated because we have created infrastructure for that. Earlier, iske pehle there was nothing, so this was new. But now we know that if something happens which leads to excess liquidity, let's say India made khadi products are in demand worldwide. So they are sold across and sales double, triple, 4 times they increase in 1 year only. Then lot of dollars will again flow. Government will again activate this. समझ में आ रहा है? Are you understanding this? Because when you sell khadi products to the world, they will pay you in dollars. When they are paying you in dollars, your liquidity is rapidly increasing. And RBI does not want this liquidity to go into the money supply because then it will lead to inflation. Are you able to link all these things together? That is very important. So now I am going to teach you a very common, very generic term, not specific to this. Okay? But that term means, so do you know that a medical, when you go to hospitals or when you go to clinics and all, they the medical instruments which they have for surgery and needles and all of that, they sterilize it. Do you know that they sterilize it? Sterilization means what? To purify it, right? Sterilization means, they put it in boiling water and they put some chemicals, Dettol or something like that. They sterilize it. Sterilization means cleaning, basically, purifying it or cleaning. Similarly, when foreign funds come to India in a big manner, you have to clean those funds. Clean matlab kya? You have to take it away. If foreign funds start flowing in this room will start flooding. So you have to take them away. You have to take them away, right? So this act or this process of sucking out foreign liquidity from Indian economy, foreign liquidity has come, of sucking out foreign liquidity from Indian economy, or to prevent it from reaching Indian economy, or to prevent it from reaching the money supply, which is what we are doing here essentially. But this was a window name. But this process of sucking out liquidity or prevent the foreign liquidity to reach Indian economy is called as sterilization. You are cleaning the funds. And this is especially with respect to foreign funds, because foreign funds जब आते हैं तो छप्पर फाड़ के they come at a very rapid pace and they go also at a very rapid pace. What kind of money am I talking about? When they come very rapidly and they go immediately. Have we done this? Hot money. Okay, hot money. So these are all safeguards which we have. So what is sterilization? In one line you should say sterilization is the act of sucking out excess foreign liquidity from the economy or preventing it from reaching the Indian economy is sterilization. Who conducts sterilization operations? RBI and government together conduct sterilization operations. Is sterilization free? Because RBI or government will have to pay interest on this also. See, this is a way of sterilizing by releasing new bonds, or there can be some other way also. RBI will create a new window tomorrow, special window for only buying dollars or pounds, etc. Okay, so sterilization is a process or a generic term. MSS bonds or release of MSS bonds are one way of doing sterilization. Okay? Are you understanding everything about monetary policy so far? We will be linking monetary policy with fiscal policy at the end of the chapter. When monetary policy, now what do you think happens when monetary policy follows an expansionary path and fiscal policy follows a contractionary path? What do you think happens? That we'll see at the end of the chapter. It's very funny when both of them disagree. When government says we should follow stimulus and monetary policy says we should not follow stimulus, we should contract the economy. Okay? Very interesting things. Chalo, done? Done? Simple. I'm going very slow so that you are able to understand these things, so that you are able to grasp these things, so that you are able to link these things with all the chapters. See, all the chapters we have done till date. We have done, I think, 4 chapters: introduction, basic chapter, fiscal policy, taxation, and then now monetary policy. We are on the 4th chapter, and this constitutes around 60-65% of your syllabus, economic syllabus. Okay. So now what we'll do is, now I have a question for you. Simple question. Chalo. RBI hai, bolo hai. Let us take what is your favorite bank? Let us take a different bank today. We'll take ICICI Bank. Okay. Now ICICI Bank is there. RBI gives funds to ICICI. ICICI loans out these funds. Yes or no? Straightforward and simple. From where does ICICI get funds to loan? Either from RBI or from deposits. I told you banks also get deposits. So let's say deposits are coming. And then they are lending these funds. Okay? See, always remember, deposits form the major source of lending funds from ICICI. This is just an emergency. Remember, overnight liquidity mismatch, LAF, some excess funds required, MSF. Okay? So this is a hotline. This is phone a friend. Uske pehle you are trying to answer with deposits only. So now let me take you 2 minutes to how banks function. We'll see that in detail in banking chapter, but you need to know how banks function to be able to appreciate it. Right? What do you know about banks? When you go to a bank, what all services does it provide? It provides 2 major services, which is accepting deposits and giving loans. So if you are in need of funds, you go to a bank and you take a loan. If you have funds to save, then you go to bank and you say, please open my account, I want to save money. Barabar hai? So bank, can I say this is the bank? Can I say deposits is my input? And what is my output? Okay. What kind of deposits do you know about? What are the different types of accounts do you know about? Savings account. Do you know something called as savings account? Current account. Do you know something called as fixed deposit account? You might have heard something called as recurring deposit account. Okay. These are all types of deposits. What are the types of loans? Home loan, personal loan, business loans, capital loans, so many types of loans. Motor loans, car loans, etc. Okay? So this is how banks function. What do you think? Banks give interest on deposits or banks give interest on loans? Banks give interest on deposits or banks give interest on loans? Banks give interest on deposits. Bank charge interest on loans. Yes or no? Now what do you think? Interest given on deposits would be higher or lower than interest charged on loans? What do you think? Think logically from a business angle. Interest given on deposits would be lower or higher than interest charged on loans? Interest given on deposits would be lower than interest charged on loans. Why? Because bank is earning interest here and bank is giving interest here. So bank will obviously charge more from loans. So if it will give you loan at 8% and it will give you only 4% as savings account deposit. Yes or no? So you see the savings rate. You ask your mom and dad, ask your parents or ask your elder brothers or sisters, how much are you earning in your savings account? So they will say around 3 to 4%. Okay? And then if you have taken a loan, if your parents have taken a loan, ask them how much interest are they paying. They will say 7 to 8%. Okay, this is what is the difference amongst these things, profit of the bank. Okay, this is fairly easy to understand, right? Now, moving ahead, when you deposit money in your bank account, can you withdraw it anytime? Yes. Assuming you are not investing in fixed deposit or recurring deposit, you can withdraw money anytime from savings. Now, what would happen if your money is already given out as loan to someone else? What would happen? What would happen if your money is already given to someone else? So the problem hai, because there is a possibility you deposit 10,000 today, tomorrow bank will send that money as loan to someone else. Uska business hai wo, to use money, to use your money to give it out as loan, right? So what would happen if you go to the bank and you demand your money back, you want to withdraw it, but bank says ki sir, but I have already given that money as loan to someone else. So there is a problem, right? There is a problem. So that is why we have certain rules, certain laws and certain regulations. We have RBI says that you have to keep some money out of the total deposits you have received. You have to keep some money with yourself, and rest money you can give it with you can give as loans. Samjha? You have to keep some money as reserve. Samjha? Why? Because you want to meet the withdrawal requirements of the depositors. Are you understanding? Because see, today if 10,000 people open a new bank account today across India in ICICI Bank, it doesn't mean that 10,000 people will tomorrow withdraw money, but at least 1,000 will withdraw money. So unka keep money with you only. Don't loan it out. Don't give it out as loans. Rest 9,000 you can give. Sir, how to estimate then whether it will be sufficient or not sufficient? That banks are experts. They employ experts like CFAs. They employ experts like economists. They do a statistical analysis. For example, during Diwali, lot of withdrawals are made. Yes or no? So during Diwali, banks keep a lot of money with them and loan out less funds. ठीक है, समझा? So they do all these analysis and then they keep some money with them and then they give the rest of the money as loans. Are you understanding this? They received a lot of money in form of deposits, but all deposits they cannot give out as loans. They have to meet the withdrawal requirements. They have to pay their own salary also, their own employee salary, electricity expenses. So they keep some money with them and then rest of the money they loan it out as, they give it out as loans. Samjha? Can I say that I am keeping a fraction of my deposits as with me and rest I am giving out as loans? So this system of keeping out some fraction of my deposits with myself and giving the rest out as loans is called as see English. Oh sir, next level sir. Fractional reserve banking. Did you understand why fractional reserve banking? This is a very important term again. Fractional reserve banking. You have to keep certain fraction of your deposits as reserves and then rest you can bank or rest you can lend it out. Samjha? Now, isme there are different types of reserves which you have to keep. Different requirements, different reserves which you have to keep. Okay? So who do you think controls all this? RBI. RBI says how much to keep. Okay? RBI calls up HDFC Bank or ICICI Bank in our latest example. RBI calls up and says ki you need to keep some money with yourself and rest lend it out. Okay? Tomorrow ICICI fails to do that or ICICI does not keep enough money. RBI gets frustrated. RBI says you do one thing, you don't keep money with yourself, मेरे को दे दो, keep it with me. I will keep it safe. तुमसे ना हो पाएगा. ठीक है? RBI is telling ICICI Bank you are receiving 100 rupees as deposits. You have to keep 5 rupees side mein. 95 you can give it out as loan. But that 5 rupees keep it with me. When you need, I will give it. It's your only. When you need, I will give it. It's your only. Just keep it with me. Safe keeping. Okay? Yes or no? Right? So this money which banks have to keep as reserves with RBI, not with themselves, with RBI. They have to keep in the form of cash only. ICICI says, sir, can I keep gold with you? Utne amount ka RBI says no. ICICI says, sir, can I keep house documents or home documents of my customer who has mortgaged it, who has kept it girvi? Can I keep that with you? RBI says no. I need cash, rokda. I need cash. ठीक है. So that money which is kept by banks with RBI as a part of their deposits, and the rest money is lent it out as a part of the deposits, money which is kept by banks with RBI. Who keeps the money? Commercial banks. Where have they got the money from? Deposits. And what will they do with the rest of the money? They will give it out as loans. So that fraction of money, that fraction of deposits which banks keep with RBI is called as, very important, this is the ratio, cash reserve ratio, which means a percentage. It is often a percentage. Always remember, this is often a percentage. So now very quickly answer, if RBI increases the cash reserve ratio, more money would be there in the economy or less money would be there in the economy? Less money would be there, because RBI is saying, hey, you had to keep 5 rupees with me, now keep 8 rupees with me, less 92, you can loan it out. Okay? So this is also one of the tools of monetary policy, cash reserve ratio. RBI increasing cash reserve ratio, RBI reducing cash reserve ratio. If RBI says keep only 2% with me, which means more loanable funds are available with the banks, yes or no? Commercial banks can give more money as loans, commercial banks can do more business. So what would commercial banks want? High CRR or low CRR? What would commercial banks want? Commercial banks would want low CRR because they want to do more business. But RBI says, I am here. I do analysis. See, all this is macroeconomic analysis which they do. We are only knowing the concepts, how they do it and what all studies do they do in that and kya hota hai, that is all very in depth. Okay? Cash reserve ratio. What do you mean by cash reserve ratio? Some percentage of your what? Of loans or deposits? Of deposits which banks have to keep with whom? With RBI. In cash or in other securities? Cash. Now my question, do you think RBI will give interest to banks on this fund? Banks have kept money with RBI. So let's say CRR is 4%. CRR 4% means out of 100 rupees of deposits, you have to keep 4 rupees with RBI. Now do you think RBI will give interest to banks on this? So first of all, let us write down what we know about it. What do we know? It has to be kept in cash. It has to be kept with RBI. Okay, cash only I would suggest, I would write. Okay. It is a fraction of what? It is a fraction of deposits, right? Cash only with RBI. Do you think interest would be given? Interest is not given by RBI on this. Very important factor. Interest is not given by RBI on CRR. वो free money है. See, because RBI also does not use that fund. RBI keeps that money safely for any unprecedented event or any emergency. Tomorrow if earthquake happens or if COVID arises, you need funds in the economy. So then RBI releases all these CRR funds and everything. Okay? So why RBI is not giving interest to banks? Because RBI is not using that money for earning income. RBI is not using that money further to earn some income. RBI is keeping it with itself. Okay? It has to be cash only. It has to be, it is kept with RBI and it is, interest is not paid. Interest is not given. Samjha? It is governed by RBI Act. So RBI has the power under RBI Act 1934 to change the CRR. Can RBI change the CRR? Yes, it can. Can it increase? Yes. Can it decrease? Yes. So decreasing CRR means following what kind of monetary policy? Decreasing CRR means following what kind of monetary policy? Expansionary or cheap or dear money policy? Cheap money policy. Simple. Okay? This is also one of the tools which RBI has in its hands to control it. Okay? Now, sir, are there any limits? Sir, are there any limits in RBI Act? You cannot go beyond this rate or you cannot go above or below this rate. There used to be, now there are no limits. So it can be 0 to 100% or even more than 100%. If RBI wants, it can even say 120% rakho. Means from other funds also you have to remove and keep. So there is no, I would say there is no ceiling. Ceiling matlab upper limit. No upper limit and no floor. Floor means what? Lower limit. which means RBI can keep it 0% also, RBI can keep it 100% also. No ceiling, no floor limit. Done? These are all facts which you need to remember by heart. Cash only with RBI, no interest, RBI Act, no ceiling, no floor. Simple. So I'll tell you how banks keep CRR or how they have to keep CRR. RBI says that, so RBI sets this limit as, let's say, 4%. So you have to keep, how much rupees you have to keep? 4 rupees. If 100 rupees are deposits received, then you have to keep 4 rupees. So RBI says ki it is okay if you keep 90% of that every day, but on a fortnightly basis, which means on a 2 weekly basis, you have to keep complete 4 average. So in some days banks keep 2 rupees, some days bank keeps 3 rupees, some days banks keep 6 rupees. But overall weekly basis, fortnightly basis, they have to keep 4%. Okay, but that's not important. I am just telling you the practical this thing, right? Chalo, theek. This was one of the methods of fractional or tools of fractional reserve banking. Now what happens is that ICICI is very reckless. Let's say ICICI is very reckless for lending purposes. RBI says ICICI is lending money to people who ICICI knows are not able to repay just for increasing business. Competition hai. Whoever gives the most loans gets more business and gets more interest. Yes or no? But ICICI knows that it is being reckless. So what RBI says कि अरे यार ये फिर शुरू हो गया. You know, I told him to keep CRR. He has kept CRR with me, but again he is being reckless. So what and government also saw this. So what government did was government introduced another tool or another way of enforcing fractional reserve banking. What it told, pay attention to what I'm saying. What did it say to the banks? What did government and RBI tell the banks is that out of the deposits what you receive, invest some of it in government bonds. समझो इस बात को, just understand the statement. Out of the deposits which you receive, some part goes to RBI, some part invest it in government bonds. Are government bonds safe or risky? They are very safe because they are backed by government. What are government bonds? Issued by government when government borrows funds from banks or from anyone who is purchasing that bonds. Now, my question in the bonds transaction is, who is the borrower? Government. Who is the lender? Commercial banks. Who is the investor? Commercial banks are the investor. They are investing in bonds. So when I say that I have purchased 300 government bonds, I am saying that I have invested in 300 government bonds. I am saying that I have purchased 300 government bonds. I am saying that government has borrowed money worth 300 government bonds from me. Yes or no? When I purchase a bond, it means I am paying that money to the government. That bond is what is like a security. It will stay with me till 5 years or 4 years. After maturity, I will go back to the government. I will take your paper and give my money back. And in the period, in the interim, interest was being given to me, and then final repayment would be given at the end of 4 or 5 years, whatever is the term. समझा ये? ठीक है? So now government is forcing banks. Government is saying, अरे you are giving loan to some other idiot, some people who are not repaying you. उससे अच्छा give loan to me. Borrow my bonds or sorry, buy my bonds. समझा? ICICI is giving loan to some other person. ठीक है? ICICI is very reckless. ICICI is giving loans to people who are not even able to repay. Government says कि उससे अच्छा give some part of that loan to me, which means purchase my bonds, which means I am borrowing from commercial banks. I am government. I am borrowing from commercial banks. Give some of the portion of your loanable funds to me. So let's say 100 rupees deposit is received and CRR is 4% in our case. How much is remaining? 96 is remaining. Now ICICI is giving 96 to reckless borrowers. ठीक है? Government says कि उससे अच्छा है कि 6 rupees I will borrow from you, because I know I am a responsible borrower. I will pay you interest timely basis पे. I will repay you because I am government. I am sovereign guarantee. So now who is purchasing bonds here? So let's say it is 6 rupees. Suppose this gets divided into 6 and 90. This 90 goes to normal people who are borrowing. This 6 goes to whom? This 6 goes to government. Who is purchasing bonds here? Bank is purchasing bonds. Who is issuing bonds here? Government is issuing bonds. Yes or no? So can I say commercial bank or ICICI has invested 6 rupees in government bonds? Yes, because that is what is happening. It has invested 6 rupees in government bonds and government has borrowed 6 rupees from ICICI, government has given bonds worth rupees 6 rupees to ICICI, ICICI has purchased bonds worth rupees 6 rupees from government. Everything means one thing only, कि government is the borrower, ICICI is the lender. Simple, very straightforward. ठीक है? ICICI says sir 6 ना हो पाएगा. 6 is not possible. Why? Because government will give less interest. See, government bonds give less interest. I told you, less risk, less rate, more risk, more rate. So in finance, the number one rule I told you was to match your duration of income and expenses. You cannot use revenue receipts for capital expenditures. Okay? Second rule of financial management is that high risk, high rewards. Same like UPSC. You are taking a big risk by doing UPSC, but rewards are very high. Okay? You take a very low risk by doing BCom, but the rewards are very low. Simple. In financial management also, if you take high risk, let's say if you invest in shares are very risky, you stand a chance to earn 18%, 20% in a year. But keeping a bank account deposit with bank is low risk. Yes or no? Keeping a fixed deposit with ICICI is low risk, but you get very low returns, 4%, 3%. Samjha? High risk, high rewards. Low risk, low rewards or low returns. Similarly, this is high risk or low risk for the bank. Giving it to the government is very low risk. So rate of interest would also be very low. So ICICI says not possible. I will not be able to give you 6. So ICICI says, what ICICI says is that, now this government is central and state both, always remember. So ICICI says, I will give you 3. Government says, no, you cannot lend that 3 outside. It is very risky for you. You are going in search of business. You are becoming very aggressive. ICICI says, Shant, I am not giving it to you, but I will invest in gold. Is it okay? Gold ho gaya? Gold. Okay, gold. ICICI says, sir, gold prices are increasing. I will invest my money in gold. Instead of investing it in you, instead of investing it in your bonds, I would invest some of it in gold, which means I will buy some gold out of this 96 rupees and I will keep it with me. Is it okay? ICICI says, sir, आपको खुश करने के लिए, to make you happy, I will also keep some part of it as cash with me. Is it okay? Cash is the least risky. You have received 100 rupees, 4 rupees went to RBI. Now 96 rupees, government is telling not to give away entire 96 rupees. Government is saying give me 6 rupees. ICICI is saying, sir, I will give you 3 rupees and the rest 3 rupees I will give you as gold. Rest 3 rupees I will buy gold, or I will not buy anything. I will keep it as cash locked up in my locker. Is it okay? See, RBI is anyways happy because RBI is nothing but taking 4 rupees from it. Okay? Government says ki chalo theek hai. As far as the funds do not go to people outside your bank, as far as the funds do not go to risky borrowers, then it is okay. Samjha? Sachi samjha? Did you understand this? So this second tool which we are talking about, now why is government asking for ICICI to keep some funds aisa side mein, or to borrow some funds from commercial banks, or to invest some funds in government bonds? Why is government asking? What is the intention? What was the intention of RBI here? To meet depositors' withdrawals requirements, to meet its operational expenses. What is government's intention here? Government's intention is a similar thing. It says that you don't give out money to people who are not able to repay you on time. If tomorrow you need money, you can sell my bond and you can get money from me. I am government, I am there to support you. Tomorrow if you buy gold and some problem happens, you can sell that gold immediately and get the money, yes or no? And if you keep cash is to anyways readily available. So it is to ensure something called as liquidity. Do you know the meaning of the term liquidity? Liquidity means something which can be easily convertible to cash. Always remember this definition. It's very important to remember. You can write it down if you want. Liquidity means something which is easily convertible to cash. Is your house easily convertible to cash? No. Why? Because you will take a lot of time to find a buyer. You will take a lot of time to appoint an agent. वो sale transaction होगा, then the registration will happen, stamp duty, transferring, taxation, calculation, everything will happen. So your house is not liquid property. Samjha? What do you think is the most liquid thing you have? Cash. It is already in cash. It doesn't need to be convertible in cash. Yes or no? So the most liquid always is cash, and the least liquid is immovable property like building, land, because उसका sale में time जाता है. There are a lot of factors involved. ठीक है? Is gold liquid? Somewhere in between. You can sell gold. You can go to jeweler shop and sell the gold. Yes or no? Because gold is movable also, so you can carry along with you, right? So now tell me, is your bank account liquid? It is already in cash. Bank account है, it is in bank account, but it is still liquid. ठीक है? So hard cash is more liquid or bank account is more liquid? Hard cash is more liquid because you can distribute it anytime, any way you want, right? You cannot do that with bank account. Chalo, what is more liquid? Jewelry is more liquid or a vacant plot of land is more liquid? Jewelry is more liquid because it takes time to find buyer and all, hai na? If you have a rare piece, if you have a rare art piece, is it liquid or less liquid? It is less liquid because to find a buyer for that artwork, it will take time. It is rare piece, yes or no? So this is liquid, and so there are some things which are liquid, there are some things which are less liquid, there are some things which are illiquid. Okay, so ICICI is asking government ki, sir, why are you asking me to invest, or why are you asking me to invest in government bonds? Why are you asking me to buy gold? Because government says ki you should have some liquidity with you tomorrow. If let's say all your customers come to your bank, or tomorrow you need funds, tomorrow you are not able to pay salary, you can sell that gold and pay salary at least. Okay? So liquidity considerations ke liye you need to keep some funds with you. Getting it? Okay? So ICICI says, sir, I will keep some cash. It is liquid? Yes, it is liquid. ICICI says, I will buy some gold. Is it liquid? Yes, it is liquid. And our government also says, give some money to me also, take my bonds. You can come to me anytime and you can take the money back. Now you will ask, sir, but the bonds have a maturity period of 4 years, 5 years. How is it liquid? It is liquid because ICICI can sell that bond to any other party. So when ICICI, who has purchased bonds, who has purchased my bonds, I am government, who has purchased my bonds, I have borrowed money, ICICI has invested in me. If ICICI does not want to wait for 5 years, ICICI can sell that bond to HDFC. Then after 5 years, HDFC will come to me, I will have to repay HDFC bank, and today HDFC will pay the money to ICICI, yes or no? So who will get the interest after that? HDFC will get the interest. I don't care. I have the money, I have to pay interest either to ICICI or to HDFC. Okay? So government is telling ICICI ki invest in my bonds because my bonds are more liquid. Now is it making sense? My bonds are more liquid. You can sell it to anyone. See, HDFC will buy your bonds. Axis Bank will buy your bonds. SBI will buy your bonds. People will buy your bonds. Okay? Your bonds means the bonds which you have, which I have issued. Samjha? This window, see the English, this window is called statutory. Why statutory? Can you tell why statutory? Because it is as per a particular act. Anything as per a particular act or piece of legislation is called statutory. This is called as statutory. See this. Did you understand the English here? Statutory. Liquidity ratio, something you have to keep in liquid with you. You cannot give away all your money because the loan which you are giving, it is of 10 years. It is not liquid. He will pay you back after 10 years. He might not even pay you back. So something you have to keep with yourself. Liquidity ratio, some pocket money you should keep with yourself for emergency purposes. Yes or no? So now you only help me. Is this money or are these bonds if they are investing? So what are the ways which we discussed where they can, is it cash only or something else? Is it cash only? Is cash allowed? Yes. Is gold allowed? Yes. Are government bonds allowed? Yes. Okay, I would write government securities, not bonds, because government securities are of various types. See, government securities in short, they are called as GSECs. G-SECS, GSECs, government securities, short mein. Are they allowed? Yes. Now help me with this. Would they earn interest on GSECs? Government will give them interest, na? They have purchased bonds from the government will give them interest. Would they earn interest on cash? No. But if they keep the cash as deposit with some other bank, then they will get interest. Are they getting interest on gold? They are not getting direct interest, but they are getting appreciation of gold value because when they will sell it. So all these I can write it as interest, yes. Interest or appreciation is there of the value. Okay? does ICICI have to keep them with itself or with RBI or with government? It has to keep it with itself, own self. Bonds हो गए, bonds are also to be kept with own self only. Gold is to be kept with ICICI only. It is in ICICI's locker only. Everything will go in ICICI locker. RBI is not concerned with this. Yes or no? Because the funds are already given to RBI, which are under CRR window. Then what? I told statutory. So there is one regulation which governs banks. This governs RBI and its actions. Powers are given under RBI Act to RBI. There is one regulation which governs banks. Okay? That regulation is called as, we are going to do that in banking chapter. That regulation is called as, see this, see the year also. That is called as Banking Regulation Act 1949. Sir, why 1949? Remember 1947 we got independence, 1949 we privatized RBI, we nationalized RBI. 1949 we also brought in Banking Regulation Act, which paved the way for nationalization of SBI also. We brought about Nationalization Act in 1954. And then which bank did we nationalize in 1955? Imperial Bank of India, and renamed it as State Bank of India. Okay? So this is 1949 Banking Regulation Act. So SLR is mentioned under 1949 Act. SLR is mentioned under Banking Regulation Act. SLR is not mentioned under RBI Act. SLR is not mentioned under RBI Act. Are you getting this? Are you understanding this? It is very important. I wrote here government securities. Why? Because they are liquid. Liquid means what? They are readily convertible to cash, which means there is a ready-made buyer available if you want to sell it. You cannot give it back to the government. Why? Because it has a maturity, 10, 15, 20 years. You cannot give it back to the government, but you can sell it to someone else. Samjha? Okay? If I give you something, if I give you a mobile and if I tell you can sell it to anyone, then it is liquid. Barabar? Banking Regulation Act. Sir, is there any ceiling or is there any floor limit? What do you think? Floor limit or ceiling limit means minimum level or maximum level. Is there any minimum or maximum level to this? Then there is a ceiling of 40% and there is a floor, no limit. These are very important concepts we are talking about. Questions come on these concepts only. That is why we are giving much time, pay utmost attention to all these things. Okay? So Banking Regulation Act 1949 के अंदर है SLR, and in RBI Act there is CRR, and CRR can be anything 0 to 100%, but SLR can be 0 to 40% only, because there is a ceiling limit of 40%. There was a floor limit also, but it was removed in 2006. Remember what happened in 2006-07? We had discussed something. Try to remember what had happened in 2006-07. Something was discontinued. What was discontinued? Printing of currency was discontinued. Printing of currency to finance fiscal deficit was discontinued. Remember? So then this floor was also removed in the same year, so that rates can be varied. So now tomorrow if government wants to, or if government wants to breach this 40%, can it do it? It can do it, but it will have to amend Banking Regulation Act. वो act will have to be amended. This percentage would have to be changed. Tomorrow can it bring floor limit again? Yes, it can bring floor limit again, but it will have to amend Banking Regulation Act. Government says ki this is all very good, I know everything to do, but I don't have the time to control SLR. So under Banking Regulation Act, the power of controlling SLR is given to RBI. So RBI sets SLR, RBI sets CRR, but power to set SLR comes from Banking Regulation Act, power to set CRR comes from RBI Act. In CRR, cash is kept with RBI. In SLR, securities, cash, gold, everything is kept with the bank itself, with the commercial bank. In CRR, RBI does not pay any interest on it. In SLR, government pays interest on it. In CRR, there is no ceiling, no floor limit. In SLR, there is no floor limit, but a ceiling limit of 40%. Is this very clear? It is looking like India flag, na? Is this very clear? ये blue से लिख देता हूँ मैं, liquidity ratio. ठीक है? So now here we are talking about statutory. Why statutory? Because it is as per an act. See, this is also statutory technically because RBI Act है. Liquidity is the key term here. Liquidity. Liquidity means readily convertible to cash. So anything which you have, you can sell it immediately. That is readily convertible to cash. We see in movies na कि Often the actress is in distress and she says कि मेरे गहने ले लो, take my jewelry but give me money. Liquidity. It's all about liquidity. And then the jeweler is villain or crooked. He doesn't give the jewelry back. He says कि double cost I will charge. It's all masala. Masala से याद आया. What are masala bonds? Randomly I will ask questions. Okay. See now we have done 2-3 Zoom sessions together online. When we will be through with 15 or 20 of them, then I'll start asking questions like this in Zoom sessions also. Now you have not seen the lecture, so okay. What are masala bonds? Bonds issued by Indian corporations or foreign corporations? Indian corporations. They are denominated in rupees or foreign currency? Rupees. Who purchases these bonds? Indian people or foreign people? Foreign people. Because if Indian guy is purchasing, तो normal bond ही होगा ना, masala bond क्यों होगा? Why will it be a masala bond? It will be a normal bond. ठीक है? Is CRR and SLR absolutely clear? So when I use the term, now pay attention, when I use the term SLR securities, what do I mean by that? When I use the term SLR securities or securities accepted under SLR, what do I mean by that? Government securities which are accepted. All government securities are not accepted under SLR, but we don't need to go that much in depth because this is general studies. So government securities are accepted for SLR, that is enough to know. Right? Now one more important piece of information I am going to add here. This shows increase or decrease of CRR shows short-term action by RBI. It increases every weekly, fortnightly basis. ऐसा करता रहता है वो. This is short-term action by RBI. It shows short-term intention by RBI, and this shows long-term intention. Normally SLR is not changed. Normally SLR is not varied or not changed. ठीक है? CRR is changed frequently. Now answer my question. If RBI reduces CLR, what kind of monetary policy is it following? If RBI reduces SLR, what kind of monetary policy is it following? If RBI reduces SLR, what kind of monetary policy is it following? Expansionary policy, because RBI is asking them to keep less money in these locked up in these things and more money to flow in the economy. See, when it keeps cash, when banks keep cash, more money does not flow to the economy. When it invests in gold or buys gold, more money does not flow. When it buys government securities, money is flown to the government instead of the common people, instead of the economy. Yes or no? Then government will spend that money and it will ultimately reach the economy. But then which sector will it reach? How will it reach? That is all depending on the government policy. Samjha? Is this clear? Very clear. Okay, this has to be understood. Otherwise, I can show you 4 MCQs in the past 2-3 years which have asked this concept. Right? So in the answer also, if question comes about monetary policy actions taken by RBI or this thing, you can write. So now tell me, what all have we learned till date? If RBI wants to follow a dear money policy, what all can RBI do? Think. Tell me 2, 3, 4 things. What all can RBI do? Think and tell me. What all have we learned? पहले तो इससे ही शुरू करो कि what can RBI do to follow a dear money policy? Will it increase CRR or decrease CRR? If RBI wants to follow a dear money policy, it would increase CRR. What would it do with SLR? It would reduce SLR or increase SLR? Increase SLR. What are the other tools available which we have seen? We have seen repo rate, we have seen reverse repo rate. Yes or no? We have seen MSF rate. So now dear money policy, so it would increase repo rate, it would increase reverse repo rate, it would increase MSF rate, automatically gets increased because it is dependent on repo rate. Yes or no? Simple hai, theek hai. And if RBI wants to follow a cheap money or expansionary policy, then it would reduce all these rates. Samjha? Now I told you in the previous screen, let us revise this once. What is MSS? market stabilization scheme. It was brought in to conduct the operation of sterilization, which is nothing but sucking out liquidity from the economy in lieu of issue of bonds, and minimum interest is paid on these bonds. Yes or no? What is the meaning of standing deposit facility? What was the intention? To suck out the excess rupee liquidity which had brought in. And are these free schemes, or will government pay interest on these schemes? What is happening in HDF? Commercial banks are giving money to government, which means government is borrowing money, which means government will have to pay interest. Now one interesting thing here is that when SDF was brought in 2018, government asked RBI कि तू normally कितना देता है? Which is the rate which RBI gives to the commercial banks? Repo rate or reverse repo rate? Reverse repo rate, which RBI gives to the banks. RBI gives reverse repo rate to the banks. Yes or no? Confusing. ठीक है, RBI gives reverse repo rate to the bank because banks keep money with RBI. So government is borrowing from banks. So government is asking RBI, how much do you give to the people? RBI says, sir, we give reverse repo rate. So government said in 2018 ki let us give this at reverse repo only. Because ultimately RBI has the expertise. See, borrowing is done by government. RBI does not have the capacity to borrow that much money. Borrowing is done by government. It is done by RBI on behalf of government, and the rate given by RBI on behalf of government is the reverse repo rate. So government said ki why to have separate rates? So when you are doing your normal repo, reverse repo operations, वही rate हम set करते. We also will give so standing deposit facility bonds which were issued at that time were carrying a reverse repo rate. Whatever was the reverse repo rate, it was carrying. ठीक है? So government asked RBI कि reverse repo rate थोड़ा बढ़ा दीजिए because we want to suck out excess liquidity from the economy. But at the same time, the cost to government was also increasing because it had to give out reverse repo rate. समझा? Sterilization, SDF, MSS, LAF, fixed rate, floating rate, these all are MCLR and everything. Then you have MSF, bank rate, LTRO, TLTRO. ठीक है? Is this okay? Now please take out your mobile phones. We'll go somewhere. We'll go to a website. Let us visit a website now. ये क्या है? Let us go to RBI website. rbi.org.in है या gov है? rbi.org.in. Let us go to RBI. See, this is the RBI website. Okay. Read this. Do you understand the preamble? To regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country. We know credit available in the economy, and to its advantage to have a modern monetary policy framework. We are yet to see this. To meet the challenge of an increasingly complex economy, to maintain price stability, remember inflation, price stability, while keeping in mind the objective of growth. So growth, remember, growth should not lead to inflation, but growth should not be so low, prices should not be so low that growth is not happening. Remember, to maintain price stability while keeping in mind the objective of growth. Ki growth to karna hai, but price also should be stable. Simple. Now see this. I can explain everything here. We have covered a lot of things. Calendar for auction of Government of India Treasury bills. Remember T-bills? So what happens is that government and RBI plan these things together. It is not ki today government calls and says ki issue bonds. They plan it in advance. So 1 year's calendar is prepared. In the month of August, these many bonds will be issued by RBI on behalf of government. In the month of September, these many bonds will be issued. Then bonds issued 20 years ago will be redeemed in the month of March. ऐसा सब they have a calendar. So this is the calendar for auction of Government of India T-bills. ठीक है? See this, India's external debt as at the end of. We know what is external debt. Very good. Variation in foreign exchange reserves. Why foreign exchange reserves went up and down? I told you RBI holds foreign exchange reserves. RBI acts as a custodian of reserves. Remember? See, if we do balance of payments chapter, you would be able to appreciate this also. developments in India's balance of payments during the fourth quarter. We have not done the chapter yet, but just see that whatever we are doing is directly covered here. See this: monetary policy, research, issue of currency, regulation, financial markets, financial inclusion, consumer education protection, banker and debt manager to government, agent of government. Remember, banker and debt manager, banker to banks. Oh, sir, direct. Foreign exchange management, payment and settlement systems. Clearing. Remember, I told you clearing. Clearing. थोड़ा देसी भाषा में I told you clearing. Are you happy with this? That whatever we are reading, we have read the budget. We have read almost all budget documents we have seen. So many things we are understanding. That is what the this thing is. Objective is. Now see this. Very funny I am telling you. Do we know these terms? Do we know these terms? Policy repo rate, reverse repo rate, marginal standing facility rate, bank rate. Are these same? Pehle to. Remember I told you bank rate, they publish bank rate but it is the same as MSF rate. Discontinued the use of bank rate but still publish it same as MSF. Do you realize repo rate is more than reverse repo rate? Why? Because repo rate is something which RBI charges. It will be more than what RBI gives to the banks. Do you realize that MSF is more than repo rate because it is a penal rate? Remember plus something. So 4 plus 0.25 is 4.25 is the marginal standing facility. Is this not what we have studied? Yes. See this. Do we know these things? How much can CRR go maximum? 100%. How much can CRR go minimum? 0%. How much can SLR go maximum? 40%. How much can SLR go minimum? 0%. ठीक है? So we have covered almost everything in monetary policy. Exchange rates. See this. Did we do FBIL, Financial Benchmarks India Limited? Let us go there. Administering independent benchmark. See this. Money market, interest rates, foreign exchange. Remember FEDI, FIMDA, fixed income securities, derivatives. So all the, see this. These are the different rates which they are showing. So MIBOR is a rate which we will cover in the, this thing. क्या बोलते हैं? Markets chapter. Where it is? अच्छा परिल में. Office. ठीक है? So far so good. Right? See this. Sir, we have done all this. Sir, we know all this. Base rate इसके नीचे जाना नहीं है. This is the marginal cost of funds, savings deposit rate, term deposit rate. समझा? And when we do the markets chapter, you will be able to appreciate these things also. See, I'll show you this thing. See this. Did we do this? 91-day T-bills, 182-day T-bills. What is this? What do you think is this? Interest. So government is paying 3.443% interest on 91-day T-bills. It is paying 3.7% interest on 182-day T-bills. Why do you think interest rate is increasing as the duration is increasing? Why do you think? Because it will get long-term money for use. So this money government has to repay in 91 days, but this money has to be repaid after 1 year. So it is giving slightly more interest rate. How to read this? Try to guess how to read this. Try to guess. We have not discussed this yet. I am going to discuss it. It is a part of our current monetary policy only. But try to read this. 5.85% is something. Okay? GS means government securities. 2030 means they will mature on 2030. Sir, then what is this and what is this? That we will cover in bonds section. So this is the interest rate and this is the yield rate. How to, what does RBI do to control yield and all? That is level 10. That is much beyond our current understanding. So we will keep that for later. Point is, सब समझा इसमें से? Yes. MCLR, base rate, everything RBI live I am showing you on the website. No books referring, no nothing, no notes, nothing. Live you have to see all these. New definition of MSME. Okay? Everything is very easy to know once you know the concept. You remember I had told you at the end of the maturity, government can either repay the money back or issue a new bond or issue a new bond. For example, 91-day T-bill. After 91 days, government can issue a new 91-day T-bill in front of that, or it can repay the money. So ये वो है. conversion of Government of India security. So it replaces the bond with new. It says I will keep on paying you interest, and if you are happy with it, with this thing, and you don't need money after 91 days, you will say, okay, government, give me a new bill for further 91 days and keep paying me interest. Simple. That is called rollover. So conversion switch of Government of India's securities. Okay, we'll do all this. Abhi ye sab to baki hai. These are all banking chapters ke things, that is why. Then once again we can revisit this website and we'll see that almost everything we can cover. Okay, happy? CRR, SLR. How much is the current SLR? Abhi dekha, just live 18%. How much is the current CRR? 4%. Remember, MCLR was also given, base rate was given, bank rate was given, MSF rate was given, repo rate was given, reverse repo rate was given, so everything is given. Okay? So this is about CRR and SLR. Now my simple question to you is, this is a percentage, 18%, 4% of what? Percentage of what? Deposits. Very good. That is called as a fractional reserve banking. So deposits are not called as deposits. Wow. Deposits are not called as deposits. They have some fancy term in economics. Sorry, in banking, they have some fancy term. They are known as something else. So I will tell you what they are known as. So it is a very complicated term, but it is nothing but deposits. See this. Sir, bus karo, sir. This is foreign language to us. NDTL. This is deposits. Deposits is the Desi version or Indian word for, fancy word is net demand and time liabilities. Now I will explain why it is called as net demand and time liabilities. So I hope by now you know net means gross minus something. Kuch to khatam kiya hai. There is something. We'll come to that. Okay. You told me, kahan gaya wo? You told me these are the different deposits which you can open. Yes or no? Okay. Out of these four, 1, 2, 3, 4, which do you think you can withdraw as per your wish? The first two you can withdraw as per your wish. Okay. And even in this, if I ask you which is more liquid, current is more liquid, because savings pay there are minimum balance requirement. Yes or no? 10,000 you have to maintain, 1,000 you have to maintain, right? Current is for business purpose. You can withdraw huge amount of money, you can deposit huge amount of money, no limits. So this is more liquid than this, but that is not the point of this lecture. So can I say this? Can I say this? I can withdraw on my demand whenever I want. Don't now forget about the minimum balance and all. But I can even withdraw above minimum balance also. But I will have to pay a penalty for that, for non-maintenance. Yes or no? Can I say I can withdraw this on demand? Yes? Are you seeing where I am going with this? Can I say I can withdraw this after passage of time? दो word तो आ गए sir, NDTL में से. Sir, what are liabilities now? Do you remember assets and liabilities discussion we had done in fiscal policy? What is a liability? An obligation? Yes or no? What is an asset? A right to receive benefits. What is an obligation? A burden of giving benefits. For a bank, is deposit an asset or a liability? Is deposit a burden or an obligation? Burden or an asset? Why? Because it has to give interest on this. It has to keep this money safe. What is the asset of the bank? Loans, because it is getting interest. Okay? Demand, time, liabilities. Okay? Net baki hai, net I am coming. But did you understand why? It's a very, now imagine if you have read this term in paper. Paper wale to assume you know this. So you read ki CRR has been reduced to 4% of net demand and time liabilities, or banks have to maintain CRR as a percentage of demand and time liabilities. But sir ने तो deposits बोला था. Deposit ही है, fancy term है. I was in where I was in Northeast India, and they had served one. Not Northeast India. This happened where I was. Keep forgetting. I was in Pune only. This happened in Pune. We had gone for a meeting with a client, and we had taken. So it was a big meeting. I was a part of a big team. So we had gone to a 4 or 5-star hotel, and we had gone there for lunch. Okay? The menu card was so fancy. and then they gave something called as, I don't remember the name, it was very complicated, but wheat something something something. Paratha tha yaar wo. It was nothing but paratha. I was like, why do you give such complicated names? Paratha likho na normally. Similarly, why NDTL, right, deposit? So for our understanding, deposits is important. But yes, this term if you use, you will get brownie points. You will get bonus marks in this. Okay, so chalo. Did you understand why demand? Did you understand why time? Did you understand why liabilities? Samjha? Now pay attention to the net part of it. We wrote about ICICI receiving 100 rupees as deposits. Yes or no? 100 rupees deposit aaya. CRR if 4%, then ICICI will have to keep 4 rupees with RBI. Yes or no? Because it is CRR, it has to be kept with RBI. Now, do you think ICICI also has deposit with some other bank? ICICI has its own account with some other bank. Yes, banks have their accounts with each other also. ICICI has ICICI bank account, let's say Mumbai branch with the Mumbai branch of SBI. होता है ऐसा. They keep accounts with each other. ठीक है? So the law says that कि don't give RBI 4 rupees of deposits received. This is deposits received. Yes or no? ICICI also has deposits with some other bank. So let's say ICICI has 20 rupees deposits with SBI. So law says that 100 minus 20, 80 का 4% keep as CRR 3.2. Because this 20 is already safe na, with SBI. It is safe. It is not in your hands. Abhi tak. It is with SBI. So this is known as net. So what is net? Your deposits minus deposits with other banks. So deposits received by you, you are a commercial bank. Deposits received by you minus deposits, your deposits with other banks. The net amount ka whatever percentage would be the CRR. Samjha? Why net? Net is deposits received. What are deposits? Asset or liability for the bank? Deposits are liabilities for the bank because it is a burden on the bank to keep that money safe to pay interest to the customer. Loans are assets of the bank. Why loans are assets? Because you give loan and you expect future benefit from it. Okay? Similarly, you buy a car and you expect benefit for 5 years. Na? You run a car. Similarly, loan is like an asset. You give him loan and you expect him to pay you back. Remember in fiscal policy we spoke about this, asset, liability, etc. Remember capital expenditure are asset creating expenditures. So can I say capital expenditure, loan is a capital expenditure for a bank? ठीक है, loan. Deposit is not. है ना? Deposit is a debt creating capital receipt. Yes or no? Not non-debt creating, debt creating capital receipt. Tomorrow if government gives some bonus to a bank, then it might become a non-debt creating. But deposits are always debt creating capital receipts. Okay? Now these terms are not used in monetary policy. Always bear in mind these terms are not used. Debt creating capital receipts and capital expenditure. These are not used in monetary policy. This is just for understanding and to drawing out the comparison with fiscal policy. Conceptually same hai sab. It is just fancy names, different names are given. Okay? So this net is what? Deposits received by commercial banks minus deposits given or deposited, money deposited with other banks. Is your net. Okay? Demand is what? Demand is what? On demand which you can withdraw, savings account, current account. What is time? Your fixed deposits, recurring deposit. Why liabilities? Because it is a burden on the bank. We are now thinking from a bank angle. Ye samjha? Sir, this was about CRR. What about SLR? SLR is a percentage of what? Same, NDTL only. CRR and SLR both are percentages of NDTL, net deposit and time liabilities. So what I'll do is I'll give you a minute to write each of the slides, to take down. You can take down first slide mein kya hai? You can take down this slide and you can add your own tools which we learn. So I'll give you a minute on each slide so that you can take this down. Okay, write down the next slide. So we are talking about discretionary, base rate, MCLR, external benchmark. We went to FBIL website also, so now you'll never forget FBIL. It is a consortium of 3 institutions, or people come from 3 institutions. See, these are all industry associations. There is no what we say 100% government, or these are not ekdam government. There might be some representatives of government, no doubt, but these are all industry associations. So foreign exchange dealers, whoever are there in India, they will come together and uh, they will form FEDI, and then some people would be sent to FBIL and so on and so forth. 91-day, 180-day repo rate. Okay? Then this slide, I don't think you need to write. Just write fixed rate and floating rate somewhere. And I hope you understand. You don't even need to write what is it, fixed and floating. It is very simple to understand. Okay? Then we have this thing. This is very important. Add that to the list of tools which we had in the first slide. Repo rate, reverse repo rate. इसमें SDF and MSS भी add कर दो. So don't confuse between MSF and MSS. That is marginal standing facility, and this is market stabilization scheme that was introduced in 2011, and that is a penal rate that is for giving money to commercial banks. This is for sucking money from the commercial banks. Okay? So only one letter is different, but purpose is entirely different. Only one letter is different, but purpose is completely different. SDF also, standing deposit facility at reverse repo rate. Sterilization, I hope you know what is sterilization now. I'll be sending this across, don't worry. If you don't want to write, it's okay. Yeah, I hope this diagram is very simple for you to understand. Deposits. So deposits, I'll just add this here. Deposits are the liabilities of bank. Liabilities. And loans are the assets. Now, you know what? In the banking chapter, this will form our basis. If you understand this asset liability concept of banks, banking chapter and the entire NPA scenario is very easy. It is very simple for you to understand all these things. If not, then it becomes very difficult. I have had students getting confused so much, and then अच्छे से बिठा के समझा के then things got cleared. That is why we'll move very slowly in banking chapter also. It is extremely essential for us to understand all the concepts in depth. So by now you should read the first chapter of any reference book, the introduction chapter. You can also read the fiscal policy chapter of any reference book, or government budgeting chapter of any reference book. You can also read the taxation chapter of any reference book. Uske alawa, you don't have to read anything, because we are in monetary policy. When we cover monetary policy, you can read the monetary policy chapter. When we cover banking chapter, you can cover banking chapter. Okay? See, again I'm repeating what I have told you in the earlier lectures. Agriculture is easier because you can use your common sense. Yes or no? In agriculture, soil kharab hai, pesticides are increasingly being used, or if there is drought in an area, then you should not plant water rich crops or water intensive crops. And agriculture is more common sense. What do you think is the problem with packaging agricultural produce? So perishable products like fish and all these perish very easily, 1 or 2 days maximum shelf life. So they need cold storage, है ना, to prolong their shelf life, or they need saline waters, to salt waters may they are preserved, and all of that. So it is common sense. This is not common sense. Who will say this is common sense? This is what makes economics difficult. History is analysis is difficult, but reading and understanding is easy. Yes or no? Who killed whom? Which war? This who? ये कैसे समझता है यार? I mean, I am reminiscing my own struggles with understanding these things when I was preparing. Sir, आप तो सी हो, आपको तो पहले से आना चाहिए. अरे, I know accounting, I don't know economics. There's a difference between that. Yes, some economics was definitely covered in BCom, MCom, and CA also. But to make it easier for students is very difficult. Write this. This is the most important slide. Verbatim ऐसा ही copy कर लो. This is very, very, very important. रहा नहीं जाता. I can't control. है ना, मस्त. I told you, economics is a new language. You need to understand the word ka meaning and then it becomes so simple. We saw on the RBI website, right, the headings. Status of external debt as on March 21. Now, if we know what is external debt, we know what it will show. What it will show in status of external debt. External debt में क्या क्या components आते हैं? The biggest component is dash in external debt. What do you think is the biggest component of external debt? I told you this. External commercial borrowings, yes or no? ECB. So it will show how much is ECB. क्या दिखाएगा और वो? ठीक है, I hope you have written this. I'll give you one more minute. If you are starting, if you have just started to write this, I'll give you one more minute. Just write this down. ठीक है, so we'll this slide, so you can just write NDTL and just write this: why net, why demand, why time, why liabilities. I hope you understand this. Why net, why demand, why time, why liabilities. NDTL, net demand and time liabilities. So if I ask you CRR of what, SLR of what, I don't expect you to give an answer CRR of deposits or SLR as a percentage of deposits. That is very basic level. The correct term is net demand and time liabilities. So if I ask you what are the liabilities of a bank, then that question was actually asked to me in interview. What appears on the asset side of a bank and what appears on the liability side of a bank. That was actually asked to me. So what do you think? We have seen only one liability of a bank, which is loans or deposits? Deposits. Okay. In fact, one more question, the follow-up question was that how do you think or what is the difference between RBI's balance sheet and commercial bank's balance sheet? What are the different components which are liabilities of RBI and how are they different from liabilities of commercial bank? Very good questions I had asked because I had worked with RBI, so and basis on the background they had asked me the question. They will not ask this question to others. So for someone who is commerce and who is an accountant maybe and worked with RBI or banks, so maybe that they can expect this kind of question, these kind of questions. ठीक है, वहाँ तो मैंने जो जवाब दिया ना, I can't believe कि I gave such stupid answers in the interview. They were absolutely right, and the panel was so good कि they were helping me कि this is also different. I'm like, yeah, this is also different. So I was not able to recollect. Then 5 people are staring at you from different angles and not giving even one expression. You don't know whether you are saying makes sense or not. So what I said was absolutely correct, but I didn't give a complete answer. That is the problem. Okay, net demand and time liabilities, NDTL, ICICI, we saw the example, deposits received, deposits minus deposits with other banks is net. Okay, so it is not gross demand and time liabilities, it is not 100 pay, 100 में से 20 you have kept with, 100 you have received as deposit and 20 you have your own deposit with SBI, then 80 pay keep CRR and SLR. SLR is with RBI, yes or no? SLR is not kept with RBI, SLR are kept with the bank itself. Okay? But control of SLR is with RBI. Rates can be increased or decreased. So what do you think would have happened in COVID? SLR was reduced or increased. What do you think normally? Which kind of policy did we follow in COVID? We followed an expansionary policy because we wanted more people to have funds because they were losing jobs and all. So we followed an expansionary policy, which means we followed a cheap money policy, which means we reduced CRR and SLR. Okay? Now let me end this lecture. We'll end this lecture by telling you one interesting thing about CRR. One interesting thing about CRR is that, what do you think? Remember SDF? Remember SDF? This was to suck out excess liquidity from the bank, but it took 2 years to come in because it was a proper legal process. What do you think is the short-term tool at the hands of RBI? CRR. What do you think RBI would have done in that 2016-17 phase? Increase CRR or decrease CRR? RBI wants to suck out liquidity from the economy. RBI had increased CRR. How much? Guess karo. Chalo. How much? Abhi 4% hai. RBI said that for the 3 months, December, Jan, Feb, or 3-4 months, or that period, which is the highest inflow of funds, only that period, whatever RBI said to banks, whatever funds you are receiving in these months, keep 100% as CRR. समझा? 1 रुपया भी बाहर नहीं जाना चाहिए. Even 1 rupee should not go outside. That was known as, because it was in that time only, that period only, so it was known as incremental CRR. Incremental means additional CRR. So for those funds, you can write this down, but this happened only during demonetization. $100% CRR, incremental CRR, 100%. So for those funds which are received in those 3-4 months, so RBI said कि जब तक me and government decide on the further course of action, you should not give funds away. RBI told the commercial banks. ठीक है? Cool. Right? So we have completed 75% of monetary policy chapter. In the next lecture, we will complete this. And we might start with banking chapter also if time permits. When banking is over, I would, much of the burden over my shoulders is gone, because these are heavy chapters. After that, one lecture, one chapter, ऐसा चलेगा. Poverty chapter, 1 lecture, finished. Employment to half lecture, finished. Because क्या है employment में? What is the current state of employment? Why unemployment happens? How to solve? उससे आगे क्या ही कर लेंगे हम? What analysis is required in employment? But this requires conceptual understanding, है ना? So when we complete banking chapter and when we complete fiscal matters, money supply, all those small things, then I will tell you congratulations that we have completed most of the conceptual part of economics, right? Chalo, we'll stop here and keep revising. If you have any doubts, you can let me know, and keep on revising. That is most important. Monetary policy is as important as fiscal policy. I had told you, monetary and fiscal together comprise of more than 40% of MCQs in economics till date. So they ask questions on monetary and banking, right? So keep on revising, and we'll meet. I'll see you in the next lecture. Thank you.